Okay, we know it's Valentine's season, and we don't want to be a buzzkill. But economically speaking, there are some breakups happening right now. Not quite conscious uncoupling, as Gwyneth might say. More like conscious decoupling. You see, in economics, decoupling happens when things like assets, trade flows, no longer move in step. And we're seeing that now in central bank rate setting. President Trump's threatened trade war is helping drive a wider wedge between the Fed and the world's biggest central banks. The Fed is standing pat on rates, while many others cut. It's creating a divergence of monetary policy. So what does that all mean? And what are the potential risks? Let's get into it. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, decoupling, central bank style. I'm your host, Carmel Crimmins in Dublin. So we haven't got a relationship therapist on to discuss central bank decoupling, but we have someone even more qualified, Balazs Koranyi, our Chief European Central Bank Correspondent. Balazs, welcome back to the show.
Thank you so much for having me.
So the last time we spoke, it was to discuss Swiftonomics. Taylor's a good chronicler of, breakups. Do we think she's got a good song about central bankers going their own way?
She might. It might be, see you later, I'm gone.
So tell us, central banks, why do they like to stick so close to what the Fed's doing?
It's quite simple. It's because the Fed is the absolute biggest central bank. It dominates the world. The dollar is the world's biggest currency. Everything revolves around the dollar. So what the Fed does has implications for everybody around the world, not just in the US.
So the Fed usually leads others in setting the direction for policy. Has it always been this way, Balazs?
So look at the history. Everybody's central bank, every central bank in the world is going to tell you we have our own mandate. We do our own stuff. We don't care about the Fed.
Right.
But history tells a different story. When the Fed moves, other people move, other central banks.
Yeah.
They follow, maybe not one for one, but they're going to keep the same direction. And that's for most of the last 50 odd years. There have been, of course, very notable experiences of divergence when the Fed went one way and central banks went another way. And usually that has significant consequences.
In the modern era, Balazs, the sort of most significant example of decoupling, the biggest breakup was just before the global financial crisis, right?
You're absolutely right. The Fed started to recognize quite early that there is some stress building up in the market and started to lower interest rates. So from late 2007 onwards, the Fed was cutting interest rates, sometimes quite aggressively, in one case in an emergency meeting by 75 basis points. And at the same time, most other central banks were staying on hold, or in the case of the European Central Bank, even raising interest rates out of fear that inflation is not under control. The Swiss National Bank was also on hold. The Bank of England did some very small cutting at the same time. But the result was that the interest rate differential between these banks has narrowed quite sharply, and this caused very significant moves in the foreign exchange market. So look back on 2006, the euro was trading at about 1.20 against the dollar. By late 2008, it had moved to 1.60. Which is an absolutely massive move.
Wow.
And look at 1.60 in the context of today. We're almost at parity. So these are absolutely massive moves, which have implications for trade flows, investment flows. It has implications for what borrowers, mortgage holders, companies pay for their loans. And it had massive implications for the global economy.
Balazs, in terms of what we're seeing now, the kind of real-life, real-world example that we like to showcase on this show, how significant is the current decoupling between the Fed and the other major central banks?
So the point I would be keen to make is we need to distinguish between cause and effect. And decoupling is not the cause, It is the effect.
Mhm.
So look at what's going on the ground. The US economy is doing great. It's growing at potential or maybe above potential. Consumer confidence is robust. Corporate earnings are high. Margins are great. The US is booming. It's just happy times. The stock market is through the roof. Look at Europe. European economy is barely growing. It has been skirting a recession for 2 years now.
Yep.
Consumer confidence is very poor. Corporate margins are shrinking. The outlook is very poor. Industry has been in recession for 2 years. So there's very little hope in there. Consumers are saving so much of their money because of the poor news flow that there is no consumption.
Yeah.
So there is a very fundamental economic divergence at play. And that is the core of it all.
Right.
And that's where the central banking divergence comes. And you mentioned Trump and tariffs. You take the economic circumstances that I described
Mhm.
and you add in a tariff which raises import costs. What do you get? You're going to get inflation. And that's making the Fed nervous.
Right.
That's the core of the issue here.
Okay, so what you're saying is it's kind of a it's not you, it's me situation. Central banks are reacting to the situation in their own backyard. They're looking at their own economic fundamentals.
I think everybody is very conscious of those economic fundamentals and they understand what these mean for the economies. So we talked about the currency impact and that's a great thing to look at. So what happened since Donald Trump got elected? The euro has been weakening.
Yeah.
Every currency has been weakening to the dollar. So it's not even fair to say it's a weakness. It's basically dollar strength. The dollar is strengthening on anticipation that he's going to implement tariffs. Tariffs impede world trade, and that obviously causes inflation on the one hand, but it also is a self-correcting mechanism. When people anticipate trade to be weaker, then the currency starts to adjust to it. And that is already taking place even before the tariffs got implemented.
Right. So if you threaten Canada, the Canadian dollar takes a hit. If you threaten it with tariffs, even before even introducing them, the currency takes a hit.
You don't even need to introduce it.
Right.
If you just keep threatening it, the market will anticipate it. And the weird thing about this, and Donald Trump is not going to be happy about it, is that a stronger dollar does the exact opposite of what he wants to achieve. A strong dollar makes it cheaper for Canada, Mexico, and the European Union and China to sell their goods in the United States. And it makes it more expensive for the US to export its own product around the world. So essentially, the threat so far has achieved the opposite of what he wanted to achieve. So therefore, obviously, he has to actually carry through with it. Otherwise, he's hurting the US economy. If you look at trade numbers in December, the US trade deficit compared to a year ago has increased by, I think it was 45%. Part of it is the currency impact. Obviously, not everything is down to Trump.
Right.
But there's a large currency impact. It's now a lot cheaper to sell goods in the US than it was 6 months ago.
So Balazs, the central banks outside the US, by cutting rates, it causes their currencies to drop in value. It's like a defensive move because their exports will be cheaper in the US.
Yes, that's right. But again, we need to separate cause and effect. The central banks are not doing this to make their own economies more competitive. That would be illegal because they have a G20 agreement not to do this. They're doing this simply because inflation is going down in their own countries. So they're reacting to economic conditions and inflationary conditions, and the byproduct is the exchange rate.
But it's a nice side effect.
Yes, absolutely. It's absolutely fantastic for Germany, which is struggling to sell cars. So it's a nice little boost to get a few extra percent margins.
Now, you mentioned inflation. The other side of this, the risk for those central banks that are proceeding with cuts while the Fed stands pat, is that it can trigger inflationary forces in their economies, right?
That's right. So I would make two important points here. One is, right, so the euro has weakened, but Europe still has to import. Europe imports a lot of raw materials, especially energy. These commodities tend to be priced in dollars because that's just how the world functions. So you want to buy oil, you want to buy petrol, it's going to be in dollars. And when the dollar firms, that will make it more expensive for you at home. So there is an inflation boost, which is going to impact the consumer very, very quickly.
Yeah.
It's already feeding through to the pump prices in all over Europe. So you would say, oh, that's not good. Surely the European governments are worried about that. They would be if inflation was exceptionally high. But we're in this lucky period when inflation has actually gone down quite significantly, and it's very close to the 2% target of the central bank. In fact, there is a striking deflationary force from goods. So services inflation is very high, but goods, products that Europe imports, are actually very, very low, and it's a drag on prices. And that brings me to my second point. So America imposes tariffs on China, which it's done. China will try to sell its goods no matter what, either compressing their own margins or to find new markets, or perhaps circumvent the tariffs by selling it via Mexico or something.
Right.
So where is China going to sell if not in America? It's going to find the largest single market, which is the European Union. Does that do to Europe? It lowers prices and it lowers economic growth. So there is also a significant deflationary impact of all this. And that is why when economists look at it, they say it's very clearly a negative for growth. And it's not obvious that tariffs would have an inflationary impact because you have forces tugging you in different directions.
On the other side of the pond, what does this all mean for the US, right? In terms of, Trump's agenda. He wants to clamp down on trade deficits. He wants to get the US manufacturing again. He wants to build up trade surplus. If other central banks are cutting, what does that do for his policies, for his plans?
So again, let me start with the obvious, the distinction between the cause and effect.
Yeah.
So this is all happening because the US is in great economic health.
Mm-hmm.
The US is doing really well, and that is why this alignment of the stars happened. What will happen to the trade deficit? I can make a guarantee for you that Trump is never going to see a trade surplus. He can change the constitution, stay in office for 6 terms, and there will be no trade surplus in the US.
Because China is the world's factory and the US is the world's consumer?
Well, there's a good reason why that manufacturing left the US is because it's expensive to produce.
Mm-hmm.
You relocate at home. Well, first of all, there's no production capacity. So let's say you build the production capacity and you build the energy production for all that. Who's going to do the work? They're just deporting the migrants back to wherever. That cheap labor is essential. So you're getting rid of cheap labor. You're bringing home manufacturing. That's going to hurt everybody. That hurts the consumer because it pushes up prices. It's going to push up wages. It sounds great. We bring home the jobs, but, his billionaire friends around the White House who have taken those jobs out of the country for a very good reason. It's economic efficiency.
What is the big risk ultimately if this decoupling, deepens, the divergence grows?
Well, there are limits to divergence. So we can't pretend that it will go on forever. As I said, the dollar is the king in the market.
Right.
And so whatever the Fed does has an impact on everything. So what are the risks? Well, the currency. If the exchange rate movements are big enough or sudden enough that they start to cause inflation back home, obviously that's a big problem.
Yeah.
Central banks will have to correct course.
Right.
Second, if these market moves become disorderly, markets have been taking all this in stride.
Yeah.
And all the news flow has been taken relatively well. So you never know, but it's all good until it's not. And it's very difficult to predict when market order breaks down. And that's a point where central banks need to intervene, probably in the market, probably directly to calm investors. A third problem is when the long end of the yield curve starts to rise too much.
Right.
I mean, to put this in plain terms, a central bank will set the interest rates in the short term and the market sets the longer term interest rate. You, as a consumer who has a mortgage, you're impacted by the long end of the yield curve.
Right.
And so if you get into a situation where people start to doubt the Fed's resolve, inflation starts to de-anchor. They think Trump is going to run such a huge deficit or an economic policy that pushes up inflation. Then longer-term inflation expectations start to rise.
Yeah.
Yields rise, borrowing costs rise. That has an impact on growth, obviously, but it's going to push up borrowing costs for everybody around the world. And we're already seeing signs that the White House is more worried about the long-term borrowing costs rather than the short-term.
Right.
Because the short-term is for the market.
Yeah.
And I would say the fourth is emerging markets. Europe tends to borrow in euros. We have a large enough domestic market to finance deficits. But a lot of emerging markets are dollar funded. And when borrowing costs rise, then obviously your debt service costs rise. And when the exchange rate moves, that impacts all of your finances.
You get squeezed, basically.
You do. So there is potential for stress in emerging markets.
So where does that leave us? Like, where are interest rates going over the next few months?
So as Yogi Berra said, it's very difficult to make predictions, especially about the future. But okay, so looking at my crystal ball.
Go for it.
So what is being priced into the markets? Rate cuts everywhere, except in the US. People think that the Fed might cut just once this year, whereas for the ECB, 4 or 5 cuts altogether this year. So what does that leave us? The Fed could end the year at an interest rate above 4%, and the ECB could be at 1.75, more than a 2 percentage point gap.
Wow.
The Swiss National Bank could be at 0%.
Yeah.
Canada at 2.5%. So there's a very large gap opening between the world's big central banks, and that gap is likely to open bigger and bigger and bigger, and that's where the test comes. I've read analysts saying 100 basis points with Canada is fine, but the market is pricing 150, and that's stress territory.
Like, when's the last time we've seen that differential as wide as that? Is it back to that pre-financial crisis period?
I looked at some charts. Normally, it doesn't grow that big.
Right, okay.
Even a significant gap is quite rare.
Balazs, thank you so much. I've got to ask you before you go, are you doing anything for Valentine's Day, or do you run a mile from that? And I have to say to the listeners that if Balazs runs, it's fast. He's a former professional middle distance runner, a 2-time Olympian for Hungary. In fact, I think I can see your Olympic vests there in the background, Balazs.
That's right. Those are my vests from a long time ago in the last millennia. One is from Sydney and the other is 96 Atlanta.
Fantastic.
So it's now really up there for my boys who are doing athletics themselves as young runners, and I want them to see, this is their aspiration. For Valentine's Day, I'm celebrating my 20th wedding anniversary this year, so I have my permanent Valentine, and I will admit I haven't made plans.
Balazs, come on!
And you're giving me absolutely fantastic reminder to get going on that.
Get going on that. Thank you so much for your time.
Thank you for having me.
Thanks to Balazs for his time and his insights. You can catch his work on Reuters.com and the Reuters app. As ever, if you've any thoughts on this show, future shows, or any of our other episodes, just reach out to me on LinkedIn. Sound design, music composition, and engineering on this episode was by Alex Summer and Josh Summer. Our podcast team includes Kim Vinnell, Tara Oakes, Gail Issa, Sharon Reich-Garson, Jonah Green, Christopher Wall-Jasper, and David Spencer. Our executive producer is Lila de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.